Will come to order, and without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Legislative Proposals to Improve Small Businesses and Communities' Access to Capital. Just to get everybody on the same page here, they have moved up votes a little bit on us this morning. We have an anticipated voting time somewhere between 10:15 and 10:45. With agreement with the ranking member here, we are foregoing our opening statements because it is about you, actually. Hard to believe that Congress folks wouldn't want it to be about them, but it is about you, to hear from you all, and to make sure that we get to questions just for the members, depending on our timing. The chairman may exercise our prerogative to shorten your 5-minute question period, where we want to get through as many folks as we possibly can in a timely fashion. And with that, without objection, a gentleman from Pennsylvania, Mr. Rothfuss, is permitted to participate in today's subcommittee hearing. Mr. Rothfuss is a member of the Financial Services Committee, and we appreciate his interest in this important topic. And we are pleased that our final witness who was stuck in one of our famous lines here and getting into office buildings. We're glad you are here, Mr. Gerber. So with that, today we welcome the testimony of Mr. Patrick McCoy, the Director of Finance for the Metropolitan Transportation Authority of New York, on behalf of the Government Finance Officers Association. Mr. Mercer Bullard, Butler Snow Lecturer and Professor of Law, University of Mississippi School of Law. Mr. Michael Gerber, Executive Vice President, Corporate Affairs of FS Investments. Mr. Paul Stevens, who is the Chief Executive Officer of the Investment Company Institute, ICI. And Mr. Tom Quadman, Executive Vice President for the Center for Capital Market Competitiveness of the U.S. Chamber of Commerce. Each of you will be recognized for 5 minutes to give your oral presentation and your testimony. And without objection, each of your written statements will also be made part of the permanent record. With that, Mr. McCoy, you are recognized for 5 minutes.
Thank you. Chairman Huizenga, Ranking Member Maloney, and distinguished members of the committee, I am honored to be here today on behalf of the Government Finance Officers Association to share with you our comments on H.R. 2319, the Consumer Financial Choice and Capital Markets Protection Act of 2017, and its importance to public finance. My name is Pat McCoy, and I serve as the president of the Government Finance Officers Association. But today I will be speaking in that capacity and not in my other role as Director of Finance for the Metropolitan Transportation Authority in New York. Founded in 1906, GFOA represents over 19,000 public finance officers from state and local governments, schools, and special districts throughout the United States. This includes about 2,500 Michigan and 1,500 New York national and state GFOA members. GFOA is dedicated to advancing fiscal strategies, policies, and practices for the public benefit, including topics related to issuing tax-exempt bonds and investing public funds. I'm here to testify in support of H.R. 2319. Money market funds are an important means of financing capital requirements for state and local governments, but the SEC's change of net asset value, or NAV, accounting methodology from stable to floating has negatively impacted our ability to use them. H.R. 2319 would allow state and local governments to return to utilizing suitable investments as defined by state and local government officials rather than by the SEC. GFOA has identified 2 key issues that should be weighed as Congress considers this legislation to improve access to capital. First, money market funds have been utilized effectively to both manage liquidity for public sector investments and to provide a reliable source of working capital to fund public services and finance infrastructure investment. Legislation such as this would allow governments to seamlessly continue accessing the capital markets without increasing costs for taxpayers. Money market funds are a widely used cash management tool for individuals, corporations, as well as for state and local governments. According to Federal Reserve data, state and local governments hold over $183 billion of assets in money market funds. Money market funds themselves are key purchasers of municipal securities. Historically, they have been the largest purchasers of short-term tax-exempt debt. GFOA has supported and will continue to support initiatives that both strengthen money market funds and ensure investors have access to high-quality securities that can be bought and sold in an efficient market. However, the SEC rule change that requires a floating rather than a fixed NAV created unintended consequences that impact large governmental entities and small communities alike. Second, since the SEC rule changed from a fixed to a floating NAV, we have seen a negative impact on state and local governments. The original objective of the rule change was to protect investors in money market funds, but we think that those concerns were already addressed in the 2010 amendments to Rule 2A7. GFOA and other state and local government issuer groups supported those amendments. Despite the positive impact of the 2010 amendments, the SEC moved forward in adopting additional amendments to the rule in July 2014, which became effective just last year. Throughout that process, GFOA and public finance officers throughout the country submitted analysis showing that a floating NAV would do little to deter heavy redemptions during a financial crisis and would instead impose substantial costs on state and local governments. Between January of 16 and July of 2017, tax-exempt money market fund assets under management fell by half, from $254 billion to $135 billion, a dramatic shrinking of an important market for municipal debt. At the same time, municipalities issuing variable rate demand bonds saw their borrowing costs increase nearly double the Federal Reserve's rate increases over the same period. Many state and local governments opted to issue higher fixed rate bonds because issuing variable rate debt to money market funds was costly. In both cases, the higher costs were shouldered by taxpayers and ratepayers. Finally, the SEC rule changes implications for the investments state and local governments rely on to protect public funds. Many have specific state or local statutes or policies that require them to invest in financial products with a stable NAV. This ensures that public funds are appropriately safeguarded. Thus, state and local governments commonly use money market funds with a stable NAV for managing operating cash. Requiring a floating NAV creates an unnecessary obstacle that has steered state and local entities into very low-yielding U.S. government-backed funds or other alternatives from what was already a safe and highly liquid market. Chairman Huizenga, Ranking Member Maloney, and distinguished members of the committee, public finance officers are encouraged by and support initiatives like H.R. 2319, the Consumer Financial Choice and Capital Markets Protection Act of 2017. I thank you for the opportunity to speak with you here today, and I'll be happy to take your questions.
Thank you. We appreciate that. And with that, Professor Bullard, you are recognized for 5 minutes.
Chairman Huizenga, Ranking Member Maloney, members of the subcommittee, thank you again for the opportunity to speak before you today. I'll focus my comments this morning on the BD leverage proposal. And I would like to think that we can all agree that before permitting BDCs to increase their leverage, we need to know how much leverage BDCs actually use and ensure this information is fully and accurately disclosed. It appears to me that neither condition is currently satisfied. We do not know how much leverage BDCs actually use. And if we do not know how much leverage they use, then it follows that BDC leverage is not being fully or accurately disclosed. Over the last 3 decades, since the banking crisis of the 1980s, banking regulation has evolved to employ diverse measures of risks that provide a more accurate view of the threat of bank failure. Traditional diversification, concentration, and leverage limits have been supplemented by risk-based capital ratios, value-at-risk measures, liquidity coverage ratios, off-balance sheet contingency weightings, tiered asset categories, stress tests, and living wills. These measures have still not kept pace with the development of increasingly complex financial instruments and capital structures, but they have them within sight. The BDC leverage limit is a different story. It captures very little of the information one would need to evaluate a BDC's effective leverage. It does not consider the relative quality, priority, or term of BDC assets, nor does it capture the term, reliability, or portfolio income sensitivity of BDC loans. It does not reflect interest rate risk. Industry analysts agree the leverage limit is inadequate. One publication has stated, quote, "In our view, the raw leverage measure, debt over equity, doesn't tell the whole story, as the loans that BDCs hold have various degrees of implicit leverage," end quote. This is a bit of an understatement, as the effective ratio estimates by those same analysts bear little resemblance to the one-to-one statutory leverage limit. In the fall of 2015, for example, these analysts rated BDC leverage ratios as ranging from a low of 0.58 to 1 to a high of 7.57 to 1. The 7.57 ratio is obviously not consistent with the one-to-one statutory limit. The high of 7.57 to 1 is more than 13 times the low estimate, which shows a degree of variance that also does not comport with the statutory leverage limit. These high leverage ratios are not disclosed to investors, nor is their potentially disastrous effect. The BDC that had the 7.57 to 1 ratio showed in a recent filing that a mere 10% loss in the market value of its holdings would result in a 23.5% decline in the value of the shareholder's stake. This disclosure is still inadequate. It posits that a 10% decline is a worst-case scenario. The SEC should know better. In comparison, the Fed's worst-case scenario for its 2017 supervisory stress test assumes a 50% decline in equity values, and a 25% decline in housing prices, and a 35% decline in commercial real estate, and a 10% unemployment rate. I submit that worst-case scenario disclosure must reflect at least a 20 or 25% drop, if not a 40 or 45% drop, in order to be useful. It is fitting that the picture on the cover of this 2015 BDC scorecard is a photo of a man climbing a sheer rock face in running shoes without any ropes. I find that the inadequacies of BDC risk disclosure were matched by inadequate disclosure in other respects. A retail investor could not reasonably be expected to understand the mechanics of performance fees charged by BDC managers based on SEC-mandated disclosure. I was unable to determine whether BDC managers that charged fees on top of fees charged by underlying funds, already a questionable practice, were also double-dipping by being paid themselves by the underlying fund. Nor could I practically determine whether and to what extent a BDC was actually investing consistent with its statutory mandate. I'm also concerned about BDC's enforcement history. A recent article by a former SEC examiner, John Walsh, lists a pattern of BDC enforcement actions over just the last 10 years that is extraordinary in the light of the fact that the total number of BDCs has never been much over 100. I recommend that members consider this article, which appears in volume 14 of the Dartmouth Law Journal, before making a final decision on the pending legislation. And I again thank the subcommittee for the opportunity to appear before you today, and I'd happy to try to answer any questions you might have on this or other matters before the subcommittee. Thank you.
Thank you very much. And with that, Mr. Gerber, you are recognized for 5 minutes. And if you can put your microphone on, there you go. Thanks.
Thank you. Thank you, Chairman, and thank you, Ranking Member Maloney, and the other members of the subcommittee for the opportunity to participate in today's hearing. My name is Mike Gerber. I'm an Executive Vice President at FS Investments, formerly named Franklin Square Capital Partners. We were founded in 2007 in Philadelphia with a mission of providing mainstream investors access to institutional quality alternative asset management. We've used the BDC, among other structures, to execute on this mission. In 2009, we launched the industry's first ever non-traded BDC. We listed that on the New York Stock Exchange a few years later in 2014, creating a liquidity event for our investors. Today, we manage 5 BDCs, and we have more BDC assets under management than any other manager in the industry. We have investors from all 50 states. We have portfolio companies in 39 states. And across the industry, there are now more than 90 BDCs and more than $90 billion in assets under management in the BDC space. Importantly, no BDC failed during the Great Recession. We all know those were the worst economic times we've experienced as a country since the Depression. And I think it's a very important point to make because it's a very durable structure that has been protective of investors. As you all know, in 1980, BDCs were created through bipartisan efforts with an eye towards matching mainstream investor dollars with Main Street businesses. Because BDCs were designed with an eye towards retail investors, they are appropriately very heavily regulated. In fact, whether traded or non-traded, BDCs are among the most highly regulated investment vehicles in the marketplace. And because of our extensive public filings, BDCs are fully transparent to regulators, rating agencies, analysts, lenders, and investors alike. Specifically, BDCs register shares under the 33 Act and elect treatment as a BDC under the 40 Act. In addition, a BDC is subject to the 34 Act as a public company, meaning we must file 10Ks, 10Qs, 8Ks, and proxy statements. Contained in every Q and K is a schedule of our investments, along with the details around those investments, such as the name of the portfolio company, the size of the investment, the position within the capital stack of that investment, interest rates, and current price marks. Other key protections in the BDC include mandatory third-party custody of BDC assets, a board of directors, the majority of whom must be independent, and board approval of key matters, such as management fees and quarterly valuations of the investments in a BDC portfolio. In addition, our non-traded BDCs are also regulated by FINRA and by the Blue Sky regulators in all 50 states. Taken together, these laws and regulations ensure that BDCs are extremely transparent, minimize conflicts of interest, and provide investors with a high level of protection. One of the key mandates under the law is that BDCs must invest at least 70% of our assets in U.S. private and small cap companies. As a result, BDCs have provided a significant amount of capital to the middle market. Middle market businesses employ about 48 million people today, or 1 out of every 3 workers in the private sector. In fact, between 2011 and 2017, middle market firms generated 103.3% job growth, compared to small business at 7.4% and large firms at 52.3%. And now 42% of middle market firm companies say they expect to grow in 2018. So we believe it's important that middle market lenders like BDCs are well positioned to provide the capital necessary to fuel that growth. There are 2 key aspects to this legislation. One that would streamline offering reforms, making our offering of our securities more efficient for investors. Also, as the professor mentioned, there's a provision that would enable BDCs to increase leverage. We believe the increase in leverage is modest. First, BDCs, and important. First, BDCs would have more capital to deploy in the middle market while keeping all investor protections that I mentioned in place. Second, this would enable BDCs to build safer portfolios, delivering the same or higher returns while investing higher up in the capital stack of portfolio companies. Third, even with the proposed increase, 2-to-1 leverage would still be quite low when compared to other lenders in the marketplace. For example, banks are levered anywhere from 8-to-1 to 15-to-1. Hedge funds may even be over 20-to-1. And neither of those funds or those lending structures offer the same transparency as
Gentleman's
BDCs.
time has expired.
Yes, sir. Thank you, sir.
Thank you, and we're going to need to move to Mr. Stevens. You are recognized for 5 minutes.
Chairman Huizenga, Ranking Member Maloney, and members of the subcommittee, I appreciate the opportunity to testify today on proposals to improve access to capital for small businesses and communities. ICI is the leading association representing regulated funds globally, and our member funds are the vehicles through which more than 100 million Americans pursue important financial goals, including saving for retirement, college, or a first home. Registered funds also play a vital role in the U.S. economy. They channel capital from fund investors to the markets and users of capital. Funds help fuel innovation, growth, and job creation. And one measure that can enhance this process is Mr. Hollingsworth's bill, the Expanding Investment Opportunities Act. ICI fully supports the discussion draft because we feel its provisions to modernize offering rules for closed-end funds will provide significant benefits to these funds, to their shareholders, and to the enterprises that they can help finance. Like other registered funds, closed-end funds are comprehensively regulated under the federal securities laws and Securities and Exchange Commission regulations. They differ from mutual funds, also known as open-end funds, because closed-end funds have flexibility to invest in a broader array of assets, such as stocks and bonds issued by small private companies. For investors, closed-end funds provide enhanced income and cash flow, increased after-tax efficiency, and broader diversification. We estimate that more than 3 million American households held $271 billion in assets in 533 closed-end funds as of June of this year. Now, despite their numerous benefits, the number of closed-end funds has declined sharply by more than 19% over the past decade. In 2016, only 8 new closed-end funds issued shares, and that's a decline of 81% from 2007. Clearly, this well-established, well-regulated investment vehicle has untapped potential to help fund our economy. Mr. Hollingsworth's bill would help reverse these trends. It would reduce the burdens of certain SEC registration and communications requirements that impose heavy costs on funds and their investors without commensurate investor protection benefits. The resulting cost savings would be passed on to fund shareholders, making these funds more attractive. Now, while the discussion draft's provisions are quite technical, they actually follow well-established rules governing securities issued by operating companies. If closed-end funds could avail themselves of these rules, they would be subject to all of the same conditions as operating companies, plus the extensive investor protections of the Investment Company Act. When former SEC Chair Mary Jo White evaluated nearly identical legislative provisions in 2013, in that case with respect to BDCs, she concluded that, quote, "In my view, these provisions do not raise significant investor protection concerns." We agree, and we believe that now is the time for Congress to act. Some will argue that these changes should be left to the SEC. In fact, the Commission suggested the need to modernize registration and communications requirements for closed-end funds in 2005. Unfortunately, it's not followed through, and the Commission has no fewer competing priorities today than it's had throughout the past dozen years. We believe that the discussion draft's approach, giving the SEC 1 year to enact new regulations before the bill's provisions would take effect, is necessary and appropriate. We've also heard concerns that automatic shelf registration would allow closed-end funds, including some funds that are not traded on exchanges, to register new offerings without a full SEC review. This is true, but similar treatment for operating companies appears to have worked quite well for more than a decade. Moreover, closed-end funds that utilize these provisions already will have filed a registration statement, reviewed and declared effective by the SEC staff. For all these reasons, we wholeheartedly support Mr. Hollingsworth's discussion draft as a valuable set of reforms that will enhance financing for the economy while maintaining stringent investor protections. Mr. Chairman, if I may briefly comment on one other measure, ICI also supports the proposed offering and communications reforms for business development companies. We do not object to the bill's provisions to grant BDCs more flexibility to use leverage. Mr. Chairman, Mrs. Maloney, members of the committee, thank you again for the opportunity to testify. I'll be happy to take any questions.
Thank you, Mr. Stevens. Mr. Quadman, you are recognized for 5 minutes.
Thank you, Chairman Huizenga, Ranking Member Maloney, members of the subcommittee. Thank you for holding this hearing today. We appreciate the continued bipartisan leadership of this subcommittee on issues related to capital formation and job creation. Indeed, the passage of the Jobs Act and the recent introduction of Reg SK reforms by the SEC would not have happened without the efforts of this subcommittee. And the passage this week of bills by the House on testing the waters and accredited investor reforms show the continued dedication of this subcommittee on those issues. However, the situations of capital formation are still in dire straits, and much needs to be done to reverse the trends. To sum it up, the diminution of financial resources is calcifying entrepreneurship. During this past recession and for the first part of the recovery, for the first time ever, business destruction outpaced business creation. This occurred for a contracted period of time, and business creation rates have not come back to pre-recession norms. Bank lending to small businesses down, and small business capital needs are not being met. Firms that are less than 5 years old are being particularly hard hit, as are business loans of under $1 million. This data comes from the FDIC, Community Reinvestment Act reports, the Federal Reserve, and the U.S. Census Bureau. Our 2016 Corporate Treasurer Survey and 2017 Small Business Survey backed this government data up. But the situation is even worse. A 2016 study by the Economic Innovation Group found that between 2010 and 2014, 3 of 5 counties in the United States had more business exit than entries. And to make it even worse, 50% of all business startups occurred in 20 counties in only 7 states, representing 17% of the American population. If we are to return to historic rates of economic growth and job creation, we need to fix these problems in a comprehensive and lasting way. The Chamber in a few weeks is going to issue an IPO report, and we look forward to working with this subcommittee on some of the comprehensive proposals we are going to make. But the bills before us today are a step in the right direction. The Small Business Credit Availability Act, drafted by Mr. Stivers, deals with business development corporations. BDCs have slowly been filling the void since the recession of financial firms that have left for regulatory reasons both the middle market and small market capital areas. And BDCs need to be doing more. This bill would allow for a modest increase in leverage and would allow BDCs to deploy capital more efficiently. The SEC would continue to have oversight and regulations, and this bill would also allow for increased investor protections so that if there is an increase in leverage, investors have an opportunity over a course of a year to remove themselves from the BDC. The Expanding Investment Opportunities Act by Mr. Hollingsworth deals with expanding the well-known seasoned issuer status to closed-end funds. This will disseminate information more quickly and duplication, reduce costs, and have capital be deployed more quickly. If we allow high school students to use a common app to apply for college, we should do no less for America's job creators. The quick passage of these bills will help middle market and small businesses meet their capital needs. I also want to address a bill introduced by Mr. Rothfuss, the Consumer Financial Choice and Capital Markets Protection Act. This bill shines a light on a capital formation problem that must be reviewed. The money market fund reforms implemented by the SEC have made corporate cash management more difficult and inefficient and has reduced the pool of productive working capital. A recent study by the Treasury Strategies, which we would like to submit for the record, shows that there's a $371 billion shortfall in business capital. More troubling, this has led to a crowding out situation, so that where big businesses are removing themselves from commercial paper and going into the bank lending space to meet their short-term needs, they're crowding out middle market companies and small businesses. In conclusion, we believe that we can work together to solve these issues and put America back to work. We look forward to working with the subcommittee to find comprehensive solutions to these problems and addressing America's capital formation crisis. Thank you, and I'm happy to take whatever questions you may have.
Thank you, Mr. Squadman. I appreciate this. I am going to attempt to hold the standard and not use my full 5 minutes, but with this, I will recognize myself for 5 minutes. The SEC's final rule provided that money market funds with 2 years to comply with these new requirements, which ultimately became effective October 14 of 2016. Final rule also permits government and retail MMFs to use the method to seek and maintain a fixed NAV. Some market participants have expressed the concern that the SEC's 2014 rule would result in the loss of short-term liquidity in the capital markets, particularly in the municipal securities market. Along with Ranking Member Maloney, we wrote to the Securities and Exchange Commission to review and ask them to review the current landscape for MMFs and the impact of the 2014 rule on both short-term corporate and municipal financing. And without objection, I'd like to enter both into the record both our letter to Chairman Clayton as well as his response letter. And Mr. Quadman, Mr. Stevens, how really very quickly has the industry changed, or have we seen significant shifts in the money market since the October 26 implementation date? And then I'm also curious how the industry has adapted to the new rules.
Turn it over to Mr. Stevens in a second. We've seen a dramatic shift into government prime funds, and this is why you've also seen a dramatic retrenchment of businesses from using money market funds as a means of cash management. So it has actually changed the way that a corporate treasurer has to go out and manage your day-to-day activities in a negative way. What I would also say, too, if you look at this rule in conjunction with the Volcker Rule, Basel III, and a number of others, what it does is it places a premium on government funds or shifting money into U.S. Treasuries, which is also a concentration of risk, which I think the regulators have ignored and really should look at as well.
Okay, Mr. Stevens.
I think that's a good summary, but what I would say is many of these effects were ones that were predicted at the time that these rules were in development. The ICI said many, many times that the proposals would have exactly the kinds of adverse effects that my colleague here has said in connection with municipal finance. And the way the rules are structured, prime assets have declined very precipitously, and in their place, rising just about as much, have been government securities.
Okay. Mr. McCoy, how are municipalities currently meeting their short-term financing needs, and how has the 2014 reforms impacted how municipalities handle their cash management needs?
Sure, thank you. You know, I think in terms of short-term products available, there's really only one other meaningful product that municipalities use. It's an index-based note. So, for example, we take the SIFMA index or percent of LIBOR and put a spread on that, and that can go out for 2, 3, 4, 5 years, whatever. That is really the only good alternative other than issuing short-term notes, which are not what I would characterize as a long-term financing vehicle. So, I think from the issuance perspective, we've seen a dramatic reduction of state and local governmental issuers accessing this market. And then from an investment perspective, as I noted in my testimony, treasurers across the country that invest public funds typically are held to a fixed NAV construct for those investments. And with this rule, we've seen them leave this market.
Chairman Clayton in his letter says that basically we should just take some more time and collect some data. I mean, you have an opinion on this?
I think we're always looking at the data and what the data tells us. We can't argue.
It's more of a time element here, right?
Certainly time. Yep. We've seen assets in this complex drop by half, anticipating the rule change, and then after the rule change. So I would argue that we've had enough time and we've seen the impacts of the rule change. I don't think they're necessary.
Okay. With that, I'll yield back. The ranking member is recognized for up to 5 minutes.
Thank you so much, and I want to welcome all of the panelists here, particularly Mr. McCoy from the great state of New York and the MTA, and thank him for his work on completing the 2nd Avenue subway, the best subway in the nation, which happens to be in my district. Thank you so much. I'd like to continue on the chairman's questioning and ask you about H.R. 2319. SEC Chairman Clayton, in his response to myself and Chairman Heitzinger, stated that even if we repealed the NAV requirement for municipal and corporate funds, some investors might not come back to these funds. He stated, and I quote, "While some investors might choose to leave government money market funds and return to prime and municipal funds, such a shift also might not occur if investors newly appreciate prime and municipal money market funds' inherent liquidity and principal stability risk and therefore choose to remain in government money market funds." So what do you think of his comments? Do you think that investors who have left municipal funds would come back if the floating NAV requirement was repealed?
I do believe that that's the case. I believe that investors would take more comfort in this product if they knew that a dollar was worth a dollar at all times. And quite frankly, I think that's sort of what we believe to be a core reason why investors fled this particular product in substantial ways that they did.
Okay, then, Mr. Stevens, the Expanding Investment Opportunities Act is intended to modernize the offering rule for closed-end funds so that these funds are treated the same as normal operating companies like Google and GE. Of course, we know the SEC could make these changes on their own and decided not to extend the fast-track offering rules to closed-end funds back in 2005. So my question is, why did the SEC not include closed-end funds in the 2005 offering reform rule? Was it just an oversight, or are there differences between closed-end funds and operating companies that make it difficult to apply the fast-track offering rules to closed-end funds?
Thank you for your question, Ms. Maloney. I don't think it's the second of those. I think it's a fairly straightforward proposition. The SEC at the time said, "Oh, we'll get back to that." I'm speculating now, but sometimes it's very difficult when you have two different divisions at the SEC with responsibility that sort of overlaps. In the case of operating companies, that's the Division of Corporation Finance. In the case of the closed-end funds, it would be the Division of Investment Management, to sort of come together and converge on a set of changes that will affect regulated entities in both spaces. What we do know is that they said they'd get back to it, and 12 years later they haven't. And unfortunately, I don't think there's any prospect that they will. I'm very sympathetic to the limited regulatory rulemaking resources that they have and the many, many competing priorities. So with all the goodwill in the world, I just don't think after a dozen years we should think that they will return to the issue absent some prompting.
Thank you. And Mr. Gerber, as you know, the Small Business Credit Availability Act would allow BDCs to double their leverage. This could, in theory, allow BDCs to lend more to small, medium-sized businesses, or it could allow BDCs to simply increase their risks. So my question is, what would you use the additional leverage for? Would you lend to riskier companies, or would you lend more to credit-worthy small businesses? What would the impact be?
Well, I certainly can answer for FS Investments, and it would be the latter. It would enable us to invest in more companies, higher in the capital stack, reducing risk, but still maintaining the returns that our investors have come to expect from BDCs. And I think it's fair to assume that the rest of the industry would follow suit. And I say that because capital availability to poorer performing BDCs will not be the same as it would be for higher performing BDCs. In other words, those poor performers would not be able to do follow-on offerings, issuing new equity. They would not be able to draw down more debt from lenders, from the banks. So I think it's fair to assume that that would be an industry-wide approach, investing higher in the capital stack, taking on less risk.
Well, I'm sympathetic to the testimony of Mr. Quadman, where he said this would move more credit availability and investment to smaller sized companies that often do not get the attention they deserve. Thank you very much. My time is up.
Gentlelady's time has expired. With that, the chair recognizes the vice chairman, Mr. Holmgren from Illinois, for 5 minutes.
Thank you, Chairman. Thank you all for being here. Mr. Stevens, if I could address my first couple questions to you regarding the Expanding Investment Opportunities Act, the draft legislation that's being sponsored by Mr. Hollingsworth. From what I understand, this is a fairly simple piece of legislation that should have strong positive impact for investors and for our capital markets. Kind of 3 questions here, if I could. In general, why do you believe the number of closed-end funds has declined in recent years? And then how will expanding investment opportunities in closed-end funds benefit investors? And the kind of final part of that, can you speak to the significance of closed-end funds' flexibility to invest in less liquid securities? I know on page 2 of your testimony, you talk about this, and what are some of the examples that come to mind, and how will this contribute to capital formation? A lot there.
I hope I remember all 3 of those questions.
First one, why closed-end funds have declined in recent years?
They compete in the ecosystem of financing with lots and lots of other alternatives, and including some innovations like exchange-traded funds, which are extraordinarily popular now. They exceed $3 trillion in assets in ETFs in the United States. There is a sort of straightforward quality about ETFs. Closed-end funds are a slightly more complex vehicle. But I think the bill that Mr. Hollingsworth has in view, at the margin at least, provides a modernization for closed-end funds with respect to the way they can respond to market developments, bring their new issuances to market, inform their investors, and will make them at least marginally more competitive. Now, why is that important? I think it's important because they occupy, again, a kind of unique space within the framework of regulated investment companies. They have opportunities to invest in small enterprises and stocks and bonds that they may issue that would not necessarily be ones that an open-end or mutual fund company would. They have opportunities to leverage their portfolios in ways that mutual funds would not, and enhance the yield that they offer to investors. And they have opportunities to provide additional tax efficiencies. So in the broad array of investment opportunities, they occupy a specific place, and I think it's a good one. They've been part of our industry since 1940, and I think these modest reforms that are in view here will continue to make them an attractive option for investors without sacrificing any protections.
Thank you. I'm going to move on to the money market fund legislation. And first, Mr. Chairman, I'd like to enter a letter into the record dated December 1st, 2016, which is addressed to Speaker Ryan from the State Finance Officers Association, requesting consideration of the Consumer Financial Choice and Capital Markets Protection Act, one of the three bills we're reviewing today.
Without objection.
Next, Mr. McCoy, if I can address this to you, I was wondering if you could speak to the merits of this legislation. What have the SEC's money market fund rules meant for your cost of financing?
Thank you for that question, Congressman. As a large issuer, we need access to all parts of the yield curve to finance long-term infrastructure. And what we have observed over many years of issuing bonds and notes and products into the money market complex is that our lowest cost of funding has always been achieved using variable rate products at the short end of the yield curve, which go right into the money market complex.
Thank you. Mr. Stevens, going back to you, does the SEC have the legal authority to amend these money market fund rules, and should Congress let the SEC review the data and decide how to move forward with this rule?
It would have the authority, Congressman. You know, I've spent many more than 5 years of my life since 2007 on money market fund issues through 2 sets of really extensive reforms of money market funds. I don't think, at least from the perspective of our membership, that there's a lot of conviction around going through yet another extended process at the SEC, and I'm absolutely convinced that at the SEC they have other priorities that they'd like to be addressing.
Thank you. I'll yield back a few extra seconds here as well, so thanks, Chairman.
Much appreciated by everybody. So with that, the chair recognizes a gentleman from Georgia, Mr. Scott, for 5 minutes.
Yes, thank you, Mr. Chairman. Mr. Gerber, let me start with you. But first, let me, as one University of Pennsylvania graduate to another, welcome you to the Financial Services Committee.
Thank you, Congressman.
You get back to Philadelphia, give my regards to the Wharton School of Finance.
We will.
Let me ask you, I worked on this bill with my good Republican friend Mick Mulvaney when he was here. He's now the budget director. That will help the small business development corporations, that your bill will. And I understand that you, from my staff, that you and Mr. Stivers have made some changes to the bill, improvements to the bill, that address some of the concerns of the consumer advocates. Would you take a moment and share those with me, with us?
Sure. Thank you, Congressman. You're right. When the bill was introduced in the previous Congress, and we had a hearing similar to this one a couple of years ago on that bill, there were 5 key provisions in that bill. And 3 of those 5 provisions are no longer in the bill or not reflected in the current discussion draft that Congressman Stivers has authored. One of those 3 that is no longer in there was the subject of an amendment addressed by Congressman Himes, and that provision would have expanded the definition of eligible portfolio companies. So as you know, we have to invest 70% of our assets in private or small cap U.S. companies, and in that 30% bucket, we can invest in non-U.S., large cap, mid cap, and financial companies. And I think there was bipartisan concern over expanding the definition, particularly with a focus on not wanting BDCs to invest more in financial companies. That provision is no longer in the legislation. That has come out, and that was one that caused concern by consumer groups, investor protection groups, as well as both Republican and Democratic members here in the House and in the Senate.
Very good. Let me go to you for a moment, Mr. McCoy, on another bill that I've worked on prior to that, and that's Mr. Congressman Roth's bill, which is the Consumer Financial Choice and Capital Markets Protection Act, along with my Democratic colleague, Ms. Moore. And I wanted to make sure that you would share with the committee some of the issues. There's been an incredible disruption that I've seen in the marketplace for money market funds, specifically for the tax-exempt funds. And would you comment on that particular and see how this legislation improves that?
Sure. Thank you. You know, as I noted in my testimony, the the significant retreat from this product by retail investors who have typically invested in money market funds, tax-exempt money market funds, has had an effect to cause state and local governmental issuers who've historically been very active in that market to retrench and, as I noted, to go into other products, most predominantly fixed-rate bonds, which of course carry a higher cost of interest than a money market product, than a variable rate demand bond. So that's had an effect on our ability to access, again, what we believe to be is the most efficient part of the yield curve, again, for building infrastructure.
Okay, well, thank you very much. And Mr. Chairman, may I make just a kind of a brief inquiry to you? I want to ask if you would be kind enough, you and Chairman Henserling, would it be possible for us to move these bills? They're both bipartisan bills, and I know we're getting to crunch time at the end of the year. Do you think, working with Chairman Henserling and you, that we could get these bills on the floor for a vote and over to the Senate before Christmas?
Gentleman's time has expired. No. We will certainly be giving this full consideration, and as you can see, we have the hearing today for the purposes of gathering that information and working towards that. The fact that there is broad bipartisan support helps any and all issues coming out of this committee, and certainly helps over on the other side of the Capitol as well. So.
Yes, sir. Thank you, Mr. Chairman. Appreciate it.
Now the gentleman's time has expired. All right. With that, the chair recognizes the gentleman from Arkansas, Mr. Hill, for 5 minutes.
Mr. Chairman, I wanted to talk to Mr. Stevens a little bit more about the closed-end funds issue. Thank you for the discussion you had with my colleague about their competitive position and compared to ETFs. And one of the strong, I think, issues is that they can pursue strategies that involve some leverage and disclose that. Would you say that that's really one of the principal advantages in this ecosystem you're talking about? I mean, from an investor point of view, the transparency of the data, and reflect a little bit more on that, both on fixed income and equities.
Well, the current closed-end fund business is about maybe 60% fixed income investment and about 40% equity. And yes, I think, Congressman, their ability to use a bit of leverage in their portfolio is something that's characteristic of closed-end funds and provides them an opportunity to enhance the return to their investors. And that, I think, in part is what makes them attractive, in a sense that gives them advantages in terms of tax management and things of that nature. So again, it's a unique characteristic that they have, and we're talking about a range of different investment options. But as I said in my testimony, I think there's untapped potential there. I don't know how large it is, but untapped to be a source of financing to small enterprises and for other purposes in the economy. And that's a good thing that we expanded, in my view.
And do you think they have a advantage over attracting, as you say, smaller market cap stocks into that as a collective format rather than some of their competitors?
Well, if you think about mutual funds and ETFs, the nature of their investments, ETFs are largely index products, so they're looking at, in many instances, large cap issuers and the like. Mutual funds tend to be larger in terms of their size, and so just their ability to invest in much smaller businesses, the stocks and bonds, is going to be constrained in a way that with a smaller closed-end fund would not necessarily be the case.
Yeah, because I think that's over the years really become a real challenge, both in, we've talked in this committee many times about the cost of being public, but even if you move that down from very, very high market cap levels to smaller, you still have the coverage issues and the institutional investor interest area, even if it is a worthy company. And so we don't have many collective places for people to experiment with different market cap sizes. And again, I agree with you on indexing that it for the most part, drives to larger, more liquid names, as it should be by definition of being an index or near index type process. So do you know of a closed-end fund trend where they really do seek out smaller market cap names? Have you seen that among some of your members that have really been a source of looking for that emerging company that doesn't fit with a Morningstar style box, that doesn't have the market cap required by a larger ETF requirement?
I think that's exactly what the investment opportunities that many of them are seeking out.
So you'd say that that business is changing, before our eyes, and you think that these proposals today would make that more compelling and easier for them to pursue that strategy?
It's going to make them be able to get to market more quickly with respect to new issuance. It's going to facilitate their communications with the investing public. Now, I don't think this is going to be some revolution overnight, but at the margins, it's modernizing the ways in which they engage in the marketplace.
But I just think this is a really interesting capital formation question.
I agree.
Because you can't say that a closed-end strategy per se can compete with, large cap growth international per se, although we have closed-end funds that do that. And so this, to me, is an opportunity maybe for the industry to transform itself and change and adapt, while so many of what we would think is a traditional collective investment have moved to lower cost, different formats.
And that's why we support the changes.
Yeah, I appreciate the time. I yield back, Mr. Chairman.
We're on a roll. Gentleman yields back. With that, the chair recognizes the gentleman from California, Mr. Sherman, for up to 5 minutes.
I want to add my voice to Mr. Scott's that I hope we move forward on a markup. I'd like to thank the chair for holding these hearings and hope that it actually leads to a markup, as the gentleman said, well before Christmas. I want to first talk about small business development companies because if you look at the capital structure of the United States, we have a lot of systems that move money to large corporations, to government bonds, to real estate. And yet, the national interest, I think, requires that we are able to have vehicles that move money to small businesses, and that is where the technological changes that will give us high GDP growth are going to come from. I'd point out that the discussion draft Small Business Credit Availability Act is patterned after a bill that passed this committee 53-4, and it's my understanding that it's now a skinnier bill, which incorporates, I believe, Mr. Himes's amendment, so you have a chance to start with a 54-3, depending upon what Mr. Himes says later, and not speaking for him. That's a pretty good starting point. Mr. Gerber, in his testimony, Professor Bullard states that markets and regulators lack adequate method for estimating BDC leverage and its effect. The professor cites one industry measure that suggests that effective BDC leverage is actually several multiples of the current one-to-one limit. Can you tell us more your understanding of this concept of effective leverage? It seems like we're using a ruler with inches on it to measure the leverage of banks and other institutions in our society, and the professor is suggesting that we use millimeters to measure the leverage of BDCs. I'm all for the metric system, but then we would, in order to put things in context, also have to use millimeters for measuring the leverage of all the other financial entities. So tell me what you, explain this effective leverage as you understand it, and how it would allow, how your leverage compares, whether we're using millimeters or inches, to leverage of other financial institutions.
Well, thank you, Congressman. As I stated in my testimony and one of my answers to an earlier question, BDCs are required under the law to provide a very significant amount of transparency into our portfolios, far more transparency than the banks are required to provide with respect to their lending practices or the portfolio companies to which they lend money, far more than other capital providers in the capital markets like hedge funds. So we're already starting off with a very transparent model. One of the disclosures that is required of BDCs is that of how much leverage is being used by the BDC. Financial leverage. I mean how much money has been borrowed by the BDC so that the BDC manager can deploy that borrowed capital alongside the equity capital. That is fully transparent. That's financial leverage. I think the effective leverage, and I'm using air quotes on that, the effective leverage factor or formula is one that was designed by an analyst, and I think it speaks to the transparency of the BDC model. That analyst was able to take the information that is provided in our disclosures every quarter to come up with this formula. And I think if you were to talk to that analyst, and I can't speak for him, but I think if you were to talk to that analyst, what he would tell you is his formula is not measuring the financial leverage in a BDC. It's trying to put a score on the portfolio construction of the BDC by looking at where in the capital stack the BDC is deploying its assets. And so the lower in the capital stack any one investment is, the higher the score would be. And then he makes a bunch of assumptions. So he just puts a number on mezzanine debt. He puts a number on CLO debt. He puts a number on equity. But he doesn't actually look at the underlying portfolio company to determine how much debt is on that underlying portfolio company to come up with this score. So it's sort of a shorthand way to enable BDC investors to compare BDCs. It's not a measurement of financial leverage, and I think that's a very important distinction. I'd also add
Gentleman's time has expired. I'm sorry, we've got
Yes,
some other questions. So, gentleman from Maine is recognized for 5 minutes.
Thank you, Mr. Chairman. Appreciate it. Thank you all very much for being here, gentlemen. I represent rural Maine, and I'm very concerned about small businesses. We don't have very many large businesses in the state of Maine. We get a lot of mom and pops and a lot of mid-sized companies, small companies, and access to capital is absolutely critical. This is always something that's on my mind. Second of all is we have a lot of small savers, a lot of small investors who are looking to save for their kids' college or technical education or their own retirement. So cost and transparency is also very important when you're looking at various investment vehicles. Mr. Gerber, if I could ask you a question and just give you just a bit of information here, and you probably already know this, is that the state of Maine has benefited from BDC investment to the tune of about $76 million, including investments in Auto Europe, CashStar, Fiber Materials, Native Maine Operations, Tilson Technology, and what have you. So we're very grateful for the structure, the investment vehicle that you folks represent here on this panel today. One of my questions is, what about valuing the underlying portfolios? Tell me how this works. If you're a publicly traded BDC, do you have to mark to market any specific time? And what if you're not publicly traded? And what if I'm an investor? What about the little guy, the little investor, and I want to participate in the vehicle that you offer? How often do you folks mark to market as required by law, and should that change?
Yes, sir. So whether a BDC is non-traded or traded, it is required under the law every quarter to post a schedule of all investments in the portfolio. Mm-hmm. The law also requires a BDC to mark at least 25% of that portfolio every quarter, so 100% on the year. Mm-hmm. Now, at FS, we happen to do 100% of the portfolio every quarter.
So if I'm an investor and a small investor, I'm trying to get access to the information that you're providing such that I can determine if your investment vehicle is right for me, then the best I can do is, especially for a BDC that's not traded, is every quarter get a valuation of my investment.
That's right. And I think it's important to note that those valuations are handled by third-party valuation mm-hmm. firms. Got it. And then have to be approved by a majority of the independent directors on the board of the BDC. So not only do you have the transparency, but you have a couple of layers of independent protections.
Where does an investment in a BDC fit for a middle-class family in Maine or any other place around the country, and how would that compare to someone investing in a venture capital fund, for example?
Sure. So the investment strategies used by BDC managers are quite different than venture capital strategies. Venture capital, you're usually taking a position, an equity position in a startup company.
They're qualified investors and what have you.
Qualified investors or accredited investors in some case, but usually qualified investors. And usually that venture capital firm's strategy is to make a bunch of bets knowing that most of them will fail and hoping that a couple of them will really hit it. And so it's a much riskier venture. With BDCs, we are investing primarily in senior secured debt of established companies. So you don't have the risk of a startup, and you don't have the risk of taking an equity position. Now, that's not to say that BDC portfolios won't at times have exposure to equity and have a percentage of the portfolio in equity investments, but most BDCs are predominantly investing in senior secured loans or debt of a private company. Going back to the beginning of the question about the investor, why would an investor consider a BDC? It's an opportunity to diversify a portfolio. So the way we manage assets and the types of investments we make tend to be less correlated with the markets than a publicly traded stock or a publicly traded bond, because we're investing in private companies.
Thank you, Mr. Gerber. Thank you very much. Mr. Stevens, if you could comment a little bit on the fit of a closed-end fund when it comes to a working-class family in our society that's looking to save for the future, for their nest egg, or they're putting their kids through school or what have you. Where would a closed-end fund fit, in your opinion, as compared to a BDC?
Well, I think we have an investor base of 3 million households. Right. Our understanding is that closed-end fund shares are not uncommonly held, for example, in an individual retirement account. That may be a vehicle that can be held longer term for retirement purposes, again, as a way of diversifying your exposure to different kinds of assets. And we think that's a commonplace among the investors in these vehicles.
Thank you, gentlemen, very much for being here. Appreciate it very much.
Gentleman's time has expired. With that, gentleman from Massachusetts, Mr. Lynch, for 5 minutes.
Thank you, Mr. Chairman. I want to thank the witnesses for helping the committee with its work this morning. Mr. Chairman, I ask unanimous consent to submit a letter from the office of the mayor of the city of Quincy, Massachusetts, Tom Koch, a dear friend of mine, in support of the Consumer Financial Choice and Capital Markets Protection Act of 2017. That's H.R. 2319.
Without objection.
Thank you, sir. Tom Koch's a great pal of mine. We're not necessarily in harmony on our thoughts on this bill, but that is because every city is not run as well as Quincy, Massachusetts. Let me just put that out there. I want to turn to the other, the BDC bill there for a minute. I was one of the 4 members who voted against the BDC last time. I think the bill has been enormously improved by Mr. Himes' amendment, the gentleman from Connecticut, but I'm still not there yet. Let me just ask Professor Bullard, in your testimony, you cite the fact that at least in the earlier iteration of this bill, BDCs were allowed to invest, I think, 30% of the corpus of their funds in financial institutions. That a lot of investment was going into financial institutions and structured products, collateral loan obligations, things like that. That weren't necessarily helping small and medium-sized operating businesses. Look, if we were just talking about that, I'd be with this bill, because I do believe that we need access to capital for those smaller and medium-sized businesses. My problem is that we've allowed this significant part of this bill to be directed towards previously financial institutions and structured products that allow, I think, an amplification of the leverage and risk that's involved here. And also, it does not help. It does not help those small businesses and mid-sized businesses that we're supposed to be assisting in this bill. Is there a rebalancing is there a rebalancing that could be possible here, in addition to what Mr. Himes is doing, and I applaud his good work, to sort of make sure that the lion's share, or almost the lion's share, of good here is really directed to those companies that need the help?
Well, I guess I'd like to first say that in the last week of reading through registration statements, I have been very impressed by the number and diversity of investments in BDCs. I hadn't done that reading before, and with the weekend coming up, I recommend that highly to the members of the subcommittee.
Not likely, but thank you.
But the answer to your question is that it's hard to know exactly what the right percentage is for a leverage limit. But one direct response would be simply to require that additional leverage go 100% to the companies for which it's intended. Yeah. So to not allow doubling of leverage to be used to double the amount invested in that 30% window. Also, in my testimony, I've asked why, given that there may have been reasons in the 1980s you needed a 30% basket, why not reduce that and also directly provide more assets to those companies? And then third, in looking through the structure of these BDCs, many, if not most, have significant buffer between the limit they're allowed, meaning that they have maybe 0.5 to 0.6 ratios as opposed to a 1-to-1. And if a prudential rule of this nature is structured correctly, that should not be the case. The way the rule like this should work and works in other contexts, insurance, banking, similarly in money market funds, is that you go up to the limit. There's a mechanism that if you are pushed across it by changing asset values, which Mr. Gerber mentioned in his testimony, then there should be a grace period. It should be that you can't take on additional debt, but that shouldn't cause you, by something outside of your control, to be in violation of the limit. And I believe there should be a way in order to make adjustments. It may be the dividend requirement. It may be that banks are just not very flexible on renegotiating the 1-to-1 covenant, I guess. But if this bill goes through, I think they are going to have to renegotiate the covenant anyway. So I think there's a way that would let them get the full benefit of the current 1-to-1. And what that would do is let firms like Mr. Gerber's, and I've looked at their structure, and the concern is not his type of BDC. It's the one that is at the far end of the spectrum and is going to make life a nightmare for his BDC if there is a severe liquidity event and it fails. So I would look into that as a way of allowing BDCs to get the benefit of the leverage limit we intend.
Its time has expired.
Sorry. I'm out of time. Yeah. Thank you, Mr. Chairman. Thank you. Thank you, Professor Bullard.
With that, the gentleman from Minnesota, Mr. Emmer, is recognized for 5 minutes.
Thank you, Mr. Chair. I'd like to request unanimous consent to enter into the record a letter from the Association of Minnesota Counties, which expresses their support for the Consumer Financial Choice and Capital Markets Protection Act, and I share their support for the legislation and thank Mr. Rothfuss for his work on the issue.
Without objection.
Mr. Quadman, in your written testimony, you mentioned that Congress should, quote, look at creating the legal framework to allow for venture exchanges in an effort to improve secondary market trading for small public companies. Can you just comment on some of the issues that you see these small public companies currently face in today's market structure and how you think venture exchanges could help?
Yeah, thank you for that question, Mr. Emmers. I think the two underlying issues that are at the heart of the capital formation problem here are, one, our liquidity, two is research and information. I think one of the things that the venture exchange could do is to help drive liquidity to those small cap companies. And I think if you look at it in conjunction with the bills that we're talking about here today, you would take a multifaceted approach to try and drive liquidity into those markets. I think some of the WICC issues that we're talking about as well is going to activate other participants. And I think that helps to get at the liquidity issue. I think we're going to have to do some other things in terms of trying to drive out research and information as well.
Thank you very much. And because of our time and the votes pending, I'm going to yield the balance of my time to my colleague from Ohio, Mr. Stivers.
I'd like to thank the gentleman for yielding, and I have a yes or no question for Professor Bullard. Professor Bullard, in preparation for this testimony, did you by any chance have a chance to talk to Jonathan Bach from Wells Fargo, who's the analyst who came up with the effective leverage ratio method that you quoted so extensively in your research, in your testimony?
No, I haven't. And I'm not endorsing that leverage ratio. But
sure, thank you. I did have a chance to talk to him, and I got an email through Wells Fargo from him this morning at 7:21. Mr. Chairman, without objection, I would like to enter it into the record.
Without objection.
Thank you. So I'd like to quote from the email that Mr. Bach sent me, the statement, and I'll just quote some excerpts, but the whole statement will be entered into the record. He said he wanted to offer some additional color on the effective leverage statistic in his BDC scorecard because he's concerned many of the items are being taken grossly out of context. Those are his words. He says that first, effective leverage should not be confused with financial leverage, which is what the bill changes. Effective leverage is a chance to look at BDC's risk profile between each other based on their asset composition. Then he goes on to say, this isn't exact and in no way is the gauge of financial leverage taken on by a BDC. Then he goes on later to say, also taking a step back, if folks would like to talk about embedded leverage risks with BDCs and pass it off as financial leverage, then those same individuals might want to re-examine all bank and REIT balance sheets whose leverage would skyrocket. And in fact, Mr. Chairman, I'd like to enter into the record an analysis of some banks using the effective leverage ratio, the lowest of which would be 49, the highest of which would be 93.
Without objection.
Thank you. Then Mr. Bach goes on to say, the major point missed is that investors through this analysis and BDC transparency have actual ability to understand the overall risk composition and of each BDC. Banks don't offer that same kind of transparency. Then he says, lastly, folks arguing that effective leverage is too high, and then in quotes, thus this isn't a reason to look at the bill, miss the fact, and the close quotes, miss the fact that increasing leverage, the leverage constraint will actually make effective leverage ratios fall, not rise. At the current leverage constraints, several BDC managers are actually reaching for risk owning low-quality subordinated securities, CLO or sub-debt, to try to hit yield bogeys for investors. So I will stop there on that and yield back the balance of my time. I look forward to my time later to talk more.
I yield back. Gentleman from Minnesota yields back. With that, the chair recognizes the gentleman from Connecticut, Mr. Himes, for up to 5 minutes.
Thank you, Mr. Chairman, and thank you to all of you for being with us. And I'd like to say a special thank you to Mr. Stivers. I was one of the lonely opposition votes to the Mulvaney bill in the last Congress, really exclusively because of the leverage that one might imagine in that 30% bucket where investments in financial companies in particular are permitted. Not inconceivable that a financial company could have 10x, 15x leverage itself. You double that, you get into some pretty heady numbers. And I opposed it on that basis. And I really thank Mr. Stivers for making the change, including the one I proposed in the amendment, which I offered and withdrew. So I guess my neighbor in Massachusetts is not quite there, but I'm supportive of the bill in its revised form. Professor, you in your testimony write something, though, that is interesting to me because of my concern about that leverage in the 30% bucket. In your written testimony, you say, it's not clear that that 30% basket serves any purpose in modern financial markets. This, of course, was established when BDCs were created initially. What I'd love to do with my remaining time, I'm going to go to you and to Mr. Gerber. I think that's an interesting question, and it certainly catalyzed my leverage concerns in the last Congress. So I wonder if I could give each of you a minute to reflect on the public good associated with that 30% basket. And actually, Professor, since Mr. Gerber is in the business, let me ask him to start, and then you can respond to kind of what Mr. Gerber has anyway, Mr. Gerber.
Thank you, Congressman. I think as a threshold matter, it's important to note that that 30% basket doesn't just cover financial companies. It covers large cap, mid cap U.S. companies. It covers non-U.S. private, small cap, mid cap, large cap companies, as well as financial companies. How an individual BDC manager chooses to use that 30% bucket is a different issue. But I just think it's important to recognize that in that basket, you could have a very diverse set of assets, not just financial companies. I think that's an important point, number one. Number two, that basket is often used for the benefit of investors because there's an opportunity to use that basket to help generate yield. And part of our mission is to deliver strong returns to our investors. And so while very limited, because only in that 30% bucket, there's an opportunity to use that effectively to generate returns for investors. I'd say number three, that just because a company is a financial company doesn't mean it doesn't have value in the broader capital markets. We have financial company assets in our portfolios. We believe they're good companies. They're operating companies. They run lending businesses. They're lending to smaller businesses than we lend to, whether it's through equipment leasing programs, factoring programs, or just doing smaller deal sizes than we can do because of our scale. And those underlying portfolio companies play a very important role in the capital markets. So I'd say there are benefits to investors, and there are benefits for the capital markets in giving us the ability to deploy assets in that 30% bucket, which again are not all necessarily financial companies.
Great, thank you. Professor, let me give you 90 seconds, my remaining 90 seconds to reflect on that.
Well, I guess the short finance answer would be if investors want the additional yield from the 30%, they should get it from a vehicle that's designed to provide that. If BDCs want to compete effectively with each other, they should compete on the basis of their BDC investments, not depending on whether the BDC invests a lot or a little of the 30% in small and mid-sized companies. So from an efficiency point of view, it's much more efficient unless there's some reason that they need this release valve, which is probably what in 1980 this was intended to provide. And given the liquidity of current markets and the ability of very, very large BDCs to find the investments they need, it seems to me highly unlikely that there would be any serious impediment to their ability to do that, and it would enhance their status, essentially, as what's become a unique asset to reduce that percentage.
Great, thank you. That's more to satisfy my own curiosity, so I appreciate the reflections and yield back the balance of my time.
Gentleman yields back. The chair recognizes the gentleman from New Jersey, Mr. MacArthur, for 5 minutes.
Well, thank you, Mr. Chair. Let me talk for one moment before I ask a question. Let me talk as a businessman, which I was for 30 years, and instead of a congressman, which I've only been for 3. I have lived in the world of depending on both BDCs and closed-end mutual funds. I bought my company with the help of a closed-end mutual fund that was trying to transform itself into an operating company. Would have been a lot easier had they been able to invest without what we had to go through. And then at one point, the use of a BDC was really essential for me in growing the company. And that company with one office and 100 people grew over 15 years to 6,000 people and 100 offices. You can't do that without capital. Can't do it. And so I want to mention 3 things that I think are useful. One is just a reminder that business people rely on tranches of capital, both debt and equity capital, not one source. And so I think it's incumbent on us with good public policy to try to facilitate as many of those available tranches as possible. Second, companies evolve. And what I needed in an early stage small company was quite different than what I needed as a mid-market company. And last is there is simply no way for public policy makers and regulators to anticipate all of the things that business people can imagine. And so we should create the most flexibility, the most openness, and try to facilitate a good matchmaking environment where investors can make investments in all different kinds of opportunities and business people can find all different kinds of credit or capital, both through the credit markets and the equity markets. So I support these reforms because I think they all tend towards that. My question is on one that's a little different, and Mr. Quadman, it's for you. You mentioned in your written testimony that you supported an increase in Tier 2 Reg A plus offering limits. You supported something over the current $50 million. And the Treasury Department recently published a report also recommending that we increase those limits. There was a provision of choice, which bumped it up to $75 million. And I think that is going to be coming back as a standalone. I just wanted to ask you how you thought that increase from 50 million to 75 million would help small businesses access capital, and what the results might be from your perspective.
Thank you, Mr. MacArthur. And also I would also just add in your preamble, I would also add in international operations as well, also have a different, capital structure that businesses would need. In terms of bumping up the Reg A+, we were very supportive of the Job Act provision. We thought this is a way to help make it easier for small business to access capital to get deals done. To do that, I know even with the bump up to 50 million, it's been, I think people are still finding their sea legs there. But again, in terms of driving liquidity, we thought that the $75 million number was important. We did also participate with the Treasury Department on a specific roundtable on capital formation in the run-up to that report, and this was a matter of discussion that we had as well. So this is an important way to help inject more liquidity and deal-making for small businesses to acquire the capital they need to grow.
I appreciate that. In the interest of giving another member a chance to weigh in, I'll yield back my remaining time.
Gentleman yields back. With that, the gentleman from Illinois is recognized for 3 minutes.
Yeah, thank you, Mr. Chair, and I will try to be brief. Professor Bullard, would you be more inclined to support a bill that allowed closed-end funds to be treated as well-known seasoned issuers if they were also restricted to be reporting companies under the 34 Act?
Well, that's a great question because it really hits on my differences, I think, with Mr. Stevens. He noted properly that closed-end funds are heavily regulated under the Investment Company Act regulatory regime. It's not clear why, with respect to offering rules, he wants to take them out of that regime and to put them in a regime where they don't belong. For example, he made a comparison to closed-end funds filing quarterly reports as if they were similar to the 10-Qs filed by operating companies. Well, I would say maybe if I sent in a Christmas card to the SEC chairman every year, I might be considered to be filing annual reports, but I think that's about as close to filing a 10K as a closed-end funds quarterly report is to a real 10Q. So I think the place to do closed-end fund reform, and I would agree with many of the reforms that Mr. Stevens probably wants to accomplish, would be within that Investment Company Act regulation.
Thank you. Now, Mr. Stevens, I'm uncertain that the Investment Company Act disclosures adequately inform and update the markets to the point that they really justify a well-known seasoned issuer's status. Could you explain how current specific disclosures provide a continuous understanding of closed-end funds so that the shelf offering would be fully and adequately disclosed?
Well, I'm kind of astonished at Professor Bullard's comparison here. The SEC has developed reporting obligations based upon the nature of the activities of the reporter. Closed-end funds are investment pools. They're not operating companies. They don't have the kinds of activities, the range of activities that an operating company would. So subjecting them to the same standards as an operating company is in some sense nonsensical. If there's a need for further reporting by closed-end funds or other registered investment companies, I'm not aware of it, but the SEC can always enhance those reports. I think, frankly, there is no absence of information about closed-end funds or other registered investment companies in the United States that is desired by the market. And the only reason then to use the well-known seasoned issuer and the kind of streamlining that has been provided to public operating companies is that these closed-end funds are also subject to the Securities Act of 1933. So they're within that regime. In fact, we always say in my space, we're subject to every one of the federal securities laws. Public operating companies are not subject to the 1940 Act. So I just think that the chairman of the SEC, Mary Jo White, when she looked at this kind of treatment, in this case it was for the kind of closed-end fund that my colleague here, Mr. Gerber, is talking about, business development companies, but it could apply more broadly. She said making these changes, in her view, does not involve any compromise of investor protections. That's where we are.
I guess my time is up, and I yield back.
Gentleman's time has expired. The gentleman from Ohio is recognized for 3 minutes.
Thank you, Chairman. Thank you all for your testimony. And Mr. Quadman, thank you for your advocacy across the country for small and medium businesses, and thanks for the focus on business development corporations. Mr. MacArthur addressed some of the same things I would say as a businessman, and the importance of options. One option is no option when it comes to capital and lots of other things. With limited time, I want to say, could you address the impact the Volcker Rule has had on venture capital investment in the middle of the country? And in addition, do you see a significant public policy reason for prohibiting financial institution investment into venture capital?
Yeah, the Volcker Rule has caused a retrenchment of many different forms of capital formation that we would normally have expected to see financial institutions engaged in. It has made it much harder and more difficult for CFOs to access the debt and equity markets. So our hope is, as has been called for by the Treasury Department, that the regulatory agencies are going to take another look at the Volcker Rule. Venture capital has been under some stress from Volcker and from other areas as well. We believe that the capital formation report from the Treasury Department, I think, is actually putting forward some interesting recommendations for how having to deal with this. We also have some concerns with some legislation that has been proposed in the past with beneficial ownership disclosure, that's going to place another inhibitor on venture capital as well, which is one of the reasons why we've also opposed that.
Thank you, and I yield. To Mr. There you go.
Sorry, I was managing the managing members. Okay, well. So, I'm sorry, did the gentleman yield back? The gentleman yielded back. All right, with that, the gentleman from Indiana, Mr. Hollingsworth, is recognized for up to 3 minutes.
Well, good morning. I appreciate everybody being here and appreciate all the comments that were made early on, especially the compliments on the discussion draft that I'm working on. I certainly won't take my full 3 minutes. I know much of this waterfront has been covered, especially by my partner in working in this, Mr. Foster, a few minutes ago, but I just wanted to hit again, Mr. Stevens, if you wouldn't mind commenting on, is there anything about this particular piece of legislation that you feel like greatly endangers investors or otherwise dramatically reduces the amount of disclosure burden that we're putting on closed-end funds currently as I've proposed it so far?
To your first question, does it pose risks for investors? We would not be supporting it at the ICI if we believed that it was posing additional risk for investors. So no.
I was operating under the, I'm asking a question I know the answer to philosophy.
I'm sorry?
I said I'm operating under the old lawyer. I'm asking a question I know the answer to philosophy.
All right. And your second question is what benefits does it provide? It streamlines the issuance process. It allows closed-end funds to get to market more promptly in response to market conditions. It facilitates their ability to communicate with the marketplace and with the investing public, and hopefully find a greater interest in the investment opportunities it's bringing to the market. And I think those are all very favorable from the point of view of investors, and for the point of view, ultimately, of getting capital to work in our economy, creating jobs and economic growth.
Absolutely. And I think that's exactly the push that I've been making, right? The world is certainly not slowing down. Opportunities come up and go away very, very quickly. I want these closed-end funds to be able to capture those opportunities. And as for what was said before about whether closed-end funds are an appropriate vehicle or not for individual investors, I leave it up to those investors to make those decisions versus bureaucrats in D.C. or even legislators in D.C. deciding for people all the way across this country that might use these vehicles for specific purposes in fulfilling their financial needs. And with that, I'll yield back, Mr. Chairman.
Gentleman yields back. With that, the gentleman from Ohio, Mr. Stivers, is recognized for 3 minutes.
Thank you, Mr. Chairman, and I'll be fairly brief, too, because I know Mr. Rothfuss wants to go. My question is for Mr. Gerber. Mr. Gerber, can you explain why leverage is important and how you'll use that to get more capital to businesses that want to expand, as well as to make better returns for your investors? And if you want to also talk about why reinforce again how financial service firms allow you to help businesses that are below help BDCs help firms that are below their threshold for lending to get capital to smaller business, that'd be great.
Sure, so I'll take those in order, and thank you, Congressman, not only for the question, but for your work on this bill. In terms of the role that BDCs play in the capital markets, I mentioned in my testimony that most BDCs are deploying capital in the middle market, and that's a fast-growing sector, very important from a job creation perspective. As I mentioned, from 2011 to 2017, more than 100% growth in job creation. And so that's a very important role that BDCs play. And as my colleague, Mr. Quadman, mentioned in his testimony, we're doing it at a time where other capital providers are not. So I think from a capital markets perspective, BDCs play an increasingly important role. In terms of what we can do for our investors, again, as I mentioned earlier, it's an opportunity for us to deploy capital in ways that other investment vehicles do not, thereby giving investors an opportunity to invest differently and to build a more diversified portfolio with exposure to assets that aren't as correlated to the market as say, a mutual fund would be. To your question around how we can help smaller financial companies, I mentioned in response to a question from the gentleman from Connecticut, there are portfolio companies within BDC portfolios that are able to lend to smaller businesses. We have them in our portfolio. And so as you scale as a BDC, it's harder to do smaller deals. It's just an issue of resources. And so larger BDCs tend to do larger deals. But if we can invest in portfolio companies that have the ability to do smaller deals or lend in ways that we don't lend, it's an opportunity for us to fund companies that are in of themselves performing an important role in the capital markets.
Thank you very much. And with my remaining 14 seconds, I will just say that Mr. Rothfuss, who's about to ask questions, has done great work on HR 2319 that'll help help allow a stable net asset value for a lot of folks who need that in their investment requirements. I yield back the balance.
Gentleman's time has expired. With that, our guest today, Mr. Rothfuss, is recognized for 3 minutes.
Thank you, Mr. Chairman, and thank you for allowing me to participate in today's hearing. I'd like to take a couple minutes here and talk about my bill 2319, HR 2319, the Consumer Financial Choice and Capital Markets Protection Act of 2017. And I would note the broad-based support we've gotten from across the country, with over 200 groups and community leaders in support of this legislation. I'd like to offer for the record 2 letters, November 2nd, 2017, one from the Association for Financial Professionals, the other from the Association of School Business Officials International to committee.
Without objection.
Also, a October 3rd, 2012 article by Mr. Bullard on money market funds and life on support. I'd like to offer that as the record as well.
Without objection.
Real quick, Mr. McCoy, to your earlier point, whether we need to study this issue and the impact of this rule any further. I mean, we know what happened, right? $1.2 trillion has moved out of the private and money mutual fund sector into the treasuries.
That's correct. Yes, we've seen investors vote with their money and leave. Yes.
There are costs and benefits to any regulatory change, Mr. McCoy. Have the cost of this rule been justified?
I certainly believe so. It's an interesting question. I haven't totally focused on that, but I believe so.
In what sense? I mean, you're seeing an increase in borrowing rates for municipalities.
We absolutely are. We're seeing increased costs to issue variable rate debt into the money market funds. And that's filtered through our ability, state and local government's ability to finance infrastructure at the lowest possible cost.
And where has this money gone out of the muni funds and out of the corporate funds? Where has it gone to?
Typically, it's gone into fixed rate bonds, or as I noted, there's an alternative product out there, a floating rate note that is not eligible to be invested by 2A7 funds. But that particular product does allow municipalities to participate at the short end of the yield curve, where we get the best cost of funds.
Do you know whether money market funds that hold treasuries are immune to fluctuations in principal value?
I do not.
Mr. Quadman, would they be, if you have a money market mutual fund holding just treasuries, let's say there's a fund out there that has $1 million in treasuries, and somebody goes out, buys 1 million treasuries, starts to do this fund. Interest rate today is 1.43%, and the interest rate goes up tomorrow. What happens to the principal value in that money fund?
I would have to consult with some of our members and get back to you. I had not thought through that question, but let me do that and let me get back to you if you want to.
Well, it makes sense that the principal value is going to fluctuate, and it's going to go down. And while that Treasury bill a year from now, if it's a one-year bill, is going to be worth $1,000 a bill, it's going to be stable in that sense, but it's going to change in principal value because of the fluctuation. Mr. Chairman,
gentleman's time has expired, and we're going to miss a vote here if we're going to move quick. So I'd like to thank our witnesses for their testimony today. Without objection, I'd like to submit the following letter from the Government Finance Officers Association and a number of others in support of Mr. Rothfuss's bill. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for the responses. I ask you all to please respond as quickly as you are able, and without objection, all members will have 5 legislative days within which to submit extraneous materials for the chair for inclusion in the record. This hearing is adjourned.